Hey folks, this is Sean Hyman from the Logical Investor newsletter. You can find us at seanhyman.com or logicalinvestor.net. And those both go to the same place. So I want to share with you a quick thing about bull and bear markets in stocks. This is the S&P 500 going back since 1995, and it encompasses the last two bear markets previous to the one that we're presently in. And there's several things that people really don't they don't really know when the risks are high, and they don't really know how long bear markets can last or how they unfold. And so I wanted to talk to you about how that we have dodged all of these bear markets here, and here through the years. So I've never had to fully live through a bear market. In other words, we dodged the bulk of the downdraft. And early on, I learned a few metrics to look at that. One is the average PE ratio of the S&P 500. Once it got historically high, I knew the risks of the index's price relative to the average earnings of the index. Once they got historically stretched, that the risks were high, and that the downside risk versus the upside reward was now flipped, and now it became a lot more risky to be invested in the broader market averages. And a lot of people think, well, if I'm diversified, like in 500 stocks, 500 of the largest companies in America, then I can't really, lose a lot. Well, the index went from 1553 to 768, so it pretty much cut in half here in the 2000 crash over the course of a few years. And then this one was a little over, I don't know, like a year and a quarter, year and a half in 2008, from 1576 to 666. And not a great number there, is it? So it was like a 57, 58% crash there. So the risks were high on a PE basis here, and have been for quite some time here as well. Another thing that tells us when risks are high is how far the index is away from its 200-week moving average, which is this red line right here. Every time it gets very far away from it, it doesn't mean imminent crash, but it means dangers of massive pullback near term. And so if you couple that with it being at historic high PEs, then you know that you're in danger of a bear market unfolding. And the final thing on markets is that a lot of people don't realize is that they unfold in three major waves. So you've got, like, here's one, here's two, and here's three right here. And then this one was 1, 2, and 3 right here. So sometimes they unfold quicker, like this one unfolded in like a year and a half. This one unfolded more death by 1,000 cuts in that the first part of it was longer and faster, but the next part of it was shorter, and it spanned over 3-year period. And then here we are on this one that we've got here, which you can see a zoomed in version of this crash right here. And a lot of times, so you see how long this took and this took, and bear markets play out over time. And a lot of times people think that they're just, an event like this. This happened super quick. This was the fastest sell-off in U.S. history. And so a lot of times people think, well, that was the bottom. And historically, that's not near enough time for a bottom. But also remember, they unfold in three waves. You got your first down leg, and then you have what's called a bear market bounce. And then you've got a third down leg that goes, way down to, to new lows. And so we've only seen 2 of those waves so far. So the price had gotten a lot further away from its 200-week moving average than it had even in these past 2 crashes here. So I had my subscribers out. It also was at PEs, price to earnings ratios, that were in line with crashes. And again, we've only seen two legs of it, so one down leg and one recoil leg. And novices always think this is the bottom. They always think because they think, well, it's already retraced so much, and we're getting a strong bounce off that. And here's your strong bounce here. Here's a strong bounce here. But yet there was another huge leg to go, and there's some strong bounces within bear markets. There'll be one main one, and that's here. And then, and this had come all the way from 1576 to here, which seemed like a really, really nice buy the dip moment for those that didn't know what was up, because it was a big pullback relative to the pullbacks that they had gotten previously. And so they bought that, and that's why these are called bear market bounces, are also called bull traps, because the novice investor goes into them thinking the bottom's in. It goes up for a little bit, which seems to validate their thought process, and then it slams them. So it goes down here, the bull trap unfolds, the retail investor goes back in more towards the latter part of the bull trap, because their only confidence gauge is really what the market has done in the recent history. And so this slams down 35%, and then recoils about 2/3 of it, and or about 60% of it. And people think the bottom's in. They watch it go. They're scared to death when this happens, but when it starts to come back a bit, they get in on this latter part of the move, so they buy in, and that's the bull trap part, and then they get slammed again on the next move down. So you can see these, the MACD is heading way lower, putting in lower lows. That's a negative sign. You can see a lot of selling. You can see a lack of buying, more selling spikes than buying spikes. Institutions aren't, for the most part, stepping in here. You can see its RSI is still very weak and slumping over from where it was previously. You can see these 20 and 50 period moving averages crossing over and heading lower and acting as somewhat of a ceiling for the price action. And so we're, if we haven't reached it yet, we're likely not far from the rollover point. So I have my subscribers out. They did not, they did feel the 35% fall. Now, I will say we did take a third of 401k money and go back into the index once it had gone down far enough. And I'll tell you what was my key measuring stick to say, okay, after all of this fall, we were finally going to get in. But let me take these off of here real quick. So the index had fallen, and we got back in, and I gave word on it. Of course, it was falling so fast. Gave word on it right in here, and we got a third in our 401k. Some got in at the 2200 level, some got in at the 2300 level. So actually not far from the bottom. I'm not saying we could have called the bottom, because we can't say that. We just knew it started to be an extreme point of pessimism and negative sentiment. And there were some other indications that helped us out there as well, which I'll show you one here in a second. And then we rode this back up in just about a month's time to the 2800 level. And again, we didn't call the top of the bear market bounce on that. So between the 2200 to 2800, and some got in at 2300 to 2800, they subscribers reported a 21 to 25% gain in their accounts for that third of their 401k. The rest was in cash off of this bear market bounce, and then they're back to cash. Again, didn't quite call the top. Nobody calls an exact top or bottom. Warren Buffett doesn't. Nobody does. So me as a professional, I don't either, and openly admit that. And then there will be that next leg down that we see. So if you think this was bad and your 401k balances were bad here, wait till this comes down here and goes far lower than that. So if you want to avoid that, and you want to make better choices, and again, not saying we call bottoms, but because we don't, but we avoid a whole lot of the downdraft before we ever get in, and then we have a way of getting in that's strategically different from what most other people do. So let me show you that indicator that I used to tell when it was overblown and the fear was so thick you could cut it with a knife. I used the volatility index. It's called the VIX, and it's also known as a fear gauge. And when this goes up, most of the time it'll go up to the 40s or 50s or something like that, and show some bottoms. Twice it has been just off the charts extreme. One was in the crash of 2008. The price went up to 89.53 on the VIX, And then this latest one, it ran up to 85.47. And once it started getting into the 80s and getting close to matching this, I knew that things were probably getting to an extreme, and that it was likely time to get partially into the S&P 500 again. And so that was this fall off. So when the VIX rallies higher, the market is falling, and then when the VIX starts to fall, the market's starting to typically rally again. And so that's how I timed that better than probably many would have, and avoided a lot of that fall, because we knew the risks were so high, both from a technical and a fundamental perspective. And so there's things that, tools that we use like that in the Logical Investor newsletter that can help you. So you get a monthly newsletter, you get weekly videos where I go over our portfolio positions and tell you where I think they go next and why, again, over time. And you get access to a members forum, which we can talk about our stocks openly in that forum, naming stocks, ticker symbols, etc., and talk about them, so where you can get your questions answered. So you got a daily forum that you can access, a weekly video you can access, and a monthly newsletter that you can access. And the newsletters come with buy alerts in them when we're having buys. And not in every newsletter will have a buy alert, but when we do, they typically appear in there most of the time. Occasionally, when they don't fall in line with the monthly release, there can be a buy alert outside of that, and we have had that happen before. But those are all in our members area. You get sell alerts as well. So there's nothing left to the imagination. You know when to buy something, when to sell something, while we're in it, the whole 9 yards. So nothing left to your guesswork or to figure out. So I hope you'll come join us. I hope you'll avoid the next leg of the bear market. Again, I've been talking about this on social media for a while, and about how high the risks were, and they were very high. And nobody can say when the exact top was going to be, and I couldn't either. I can just tell you when the risks are high. So nobody can tell you when the exact bottom is going to be, but they can tell you when the risks are low fundamentally. And nobody can tell you when the top is going to be, but any pro can know when the risks are high. So to be successful in markets, you don't have to know where the bottom is and where the top is. You have to know when the risks are low and when the risks are high. And you need to be out and lightening up positions when risks are high, and you need to be more involved when risks are low. And it's going to be counterintuitive, because near tops, the sentiment is never more bullish, and people are never more cheery about stocks than at tops. And so it seems like you're doing the wrong thing by selling. Conversely, at bottoms, and that's the greed factors up here. Down here's the fear factor. The market's been going down for so long, it seems like it's never going to stop. It seems like it's never going to turn upward, and to buy in would just be stupid. Again, it seems like. But there comes a point in time, valuation-wise, where stock prices are cheap relative to their earnings. There's technical signs of turnarounds. The sentiment is so atrocious, you could, so thick you could cut it with a knife. And yet those are some of the best times to be buyers of stocks, buying low and selling high. So it's very counterintuitive to how people feel, how people act, how people react. It'll be counterintuitive to the news headlines that you see, because the news is never gloomier than here and here at bottoms, and it's never rosier than here, here, and here. So if you use news as your gauge, you'll always be behind and doing the wrong thing. If you're going along with the crowd, you're usually going to end up doing the wrong thing. So what I do in the Logical Investor newsletter is to teach you how to think like a professional. And if I can get your thinking to be thinking like a professional, then you can start to have better results in your investing. Or if you've never invested a dime ever, you can start off learning a professional-minded way of investing that can help you so much to be so much more successful than the average investor is. So anyway, we have a very defined system. It's not by gut. It's based off of fundamental analysis, firstly, how sound a company is and how cheap a company is, refined by technical analysis and sentiment analysis for entries, and similar for exits. So it's very numerically based. It's not gut. It's not feel. There's a lot of sense to it that anybody can learn. You don't have to be a pro. You don't have to know a lot of terminology. Everything is spelled out: what to buy, at what price, when to exit, etc. And so really nothing left to the imagination, even if you are newer or have not been a successful investor in the past. So come check us out, SeanHyman.com or logicalinvestor.net, and go to the home page, click on the subscribe button, and you'll be taken to the billing area. It's $17 a month. Eventually it'll go to $20 a month, but right now it's $17 a month. Again, I mean, that's like a good fast food meal, or a couple of coffees a month or something like that. And yet learning how to steer an entire investment portfolio, whether that's learning more about how to steer your 401k or IRA or an individual stock account. So for a couple $100 a year, you can really learn a ton. There's no contract. You can cancel anytime online through your own account by going to the My Account area and going to subscriptions. And so you can be a subscriber or unsubscribe at any time on your own from your end. It's not even dependent upon my end. And so you've got all the power and control and say there. And again, no contract, $17 a month, and you will have more than a college education in stocks by the time it's all said and done. Once you give me, a year or two of sitting there learning, you will be shocked at what all you learn. Okay, thanks so much for watching, and God bless. Bye-bye.